Welcome to Enlightened Wealth Strategies, the podcast where insight and knowledge meet opportunity. Please join us as we navigate the world of finance, discovering actionable strategies to help you achieve your personal financial goals.
With decades of combined experience, we're here to shed light on the topics that matter most to your financial well-being. Whether you're accumulating, preserving, or distributing your wealth, this is the place for you.
Now let's dive in and start your journey to financial enlightenment.
Hey, Bill. How you doing, Bill?
I'm good. How are you?
All right, Bill. Good to hear you.
Can't see you
yet.
Are you? There you are. Hey.
Hello, Bill.
Hi.
Well, we wanted to welcome you to our podcast. The title of our podcast is Enlightened Wealth Strategies, and I'm here with my colleague Jim Lombardo. I know you know him, and we're looking forward to discussing some of the various issues that we have that we're facing now after the election last month, what we should anticipate for the remainder of the year, which is really only a few more weeks, and what you expect going forward in the fixed income market or the bond markets. But before we even do that, perhaps you could give us a little bit background about yourself and what you do and how you do it.
Okay. I'm currently in an IAR at Belpointe Asset Management. I do business locally here as Chatham Street Advisors. I have over 30 years of experience in the business, both as a money manager and as an advisor. Most of my time was spent in fixed income, both managing money institutionally and for individuals. I don't know if that's enough, James.
Oh, well, you're leaving one piece out. You're a CPA too.
Yeah.
Maybe you don't want to tell anybody that.
Well, I'm not licensed, but was trained there.
But you were trained there. That's right. I maintained my license. But anyway, so we've seen now since the election, we've seen the rise in the equity markets. They've really gone to all new highs. The S&P 500, I think it's got 50 new all-time closing highs. It's closed well over 6,000, and the Dow Jones is pushing 40. It's at 45,000 points, but hovering in that 44 to 40, 44.5 to 44.9, somewhere in there, and all the other indices are doing the same thing. How does that, if at all, impact what you are doing with your portfolios in the fixed income sector?
Well, I do also manage some equity portfolios, so I'll give you both. Valuations are at an extreme. That's a little bit concerning. It's a momentum trade that's been going now for well on 2 years. When you look historically at momentum trades, they can last for 4 or 5 years. So, this could keep going. So I'm, on the equity side, I'm cautiously optimistic. And I can go a little bit into my investment thesis and some of the prepared stuff I've done. But on the fixed income side, when you look at credit analysis of a company, one of the first things that I was taught was to actually look at their stock price. And if the stock price is going up and growing, you would expect to get paid principal on any of their debt. So I do think it's a safe time to be investing in corporate debt. A lot of the risks that were in high yield debt have gone away in terms of the maturity walls, as well as some bifurcation in some of the weaker companies that were in high yield, actually moved to the private credit area. And the high yield market has actually gotten to be much more liquid with large issuers. So that indices changed a little bit. So I'm relatively optimistic on fixed income and on equities.
Okay.
That seems to be the going trend.
Cautiously optimistic.
Yes.
Yes.
Well, that's good. We got a consensus because I think we all kind of feel the same way. So you don't think that fixed income investing is facing any strong headwinds into the new year?
Well, I don't know, James, maybe it's a good time to transition into what I prepared because I can go
Yeah.
into
Okay.
some of that
Good.
fixed
Let's do
income.
that.
So I'm going to share my screen.
Look
So
at you
when
being
I
tech
first came
savvy.
into the business, I worked at Connecticut General Life and we were very economically driven. So I do a lot of fundamental analysis in determining my investment thesis going forward. So just give you a little bit of my investing outlook here. I'll start with the Federal Reserve and the economic outlook. The Fed's on a mission to normalize the yield curve.
Right.
And I also believe they're on a mission to continue to shrink their balance sheet. I wanted to show you a little bit of work that I've done just to give you a little basis for what I think a normalized yield curve would look like. So this is where we are today, the current rates. If the Fed were to get us to a normalized yield curve, it would be upward sloping. And what I was always taught was that if the Fed had a neutral bias, they would have a neutral meaning they're not trying to slow the economy or speed up the economy. That the Fed funds rate should be very close to the inflation rate. So the most recent PCE rate, their favorite indice for inflation, ex food and energy was 2.8 last month. So that would argue that their Fed funds target rate should end up somewhere around 2.8%. Now, a normal yield curve, you'd have some premium for the 2-year and the 5-year. I just kind of threw some numbers in there to give you a range. Those would ebb and flow based on the outlook for inflation and where the Fed actions were expected to be in the future. The 10-year rate, which pegs a lot of the economy, including the mortgage and housing market. Today we're at 4.22%. And I would think in a neutral bias, it should be Fed funds plus 1.25 to 175. So that would get us right about to where we are today, 405 to 455. So I do think we are in the right range on the 10-year. I also wanted to give you some idea where I think that would go with mortgage rates.
Right.
Today, the current conforming 30-year fixed mortgage rate is, roughly 6.90 to 7%. Mortgage rates are typically equal to the 10-year Treasury rate plus 2 to 2.5%. So that gets you to like a 605 to 655 in a normalized curve. So I don't know if you guys have any questions on
that's great.
Normalized curves, but I do think this is the direction the Fed's going to go in.
No, this is great information, Bill. Just one thing. We'll unwrap some of that. But one of the things that is often mistaken is that many people believe that the Fed, when it cuts interest rates, has an impact on mortgage rates. It does, but they don't. I don't know that what you just pointed out. I don't know that a lot of people really understand that. It's more tied to, as you pointed out, the longer term Treasury bond.
Yes, there was a time, and definitely I'm old enough to know to have experienced and actually had a 1-year floating rate mortgage, but there was a time where people had a lot of floating rate. But given the drop in rates over the last, 4, 5, 10 years, I actually have some data on that for you. Almost everybody has gone fixed. So we're actually down to like 4% of the market, of the outstanding mortgage debt is actually in floating at this point. But so here's I prepared this for you because I wanted to point out a couple of things on the direction of rates and the impact of tightening, as well as easing. So this is where the outstanding 30-year fixed mortgage rates are. So lowering interest rates on the front end, as you said, does not really impact the long end in a normal yield curve environment. For the Fed, really, when we look back at what happened in the great financial crisis, as well as in the COVID shutdown, they ended up buying and expanding their balance sheet by buying the long end of the curve, as well as buying mortgage-backed securities. So that was what drove a lot of these rates and gave the opportunity for homeowners to refinance at such lower rates. So the point I wanted to make was going back to my investment thesis is that my outlook is that there's an asymmetric economic reaction function for tightening versus easing. Okay. If they ease too quickly and give the opportunity for homeowners to refinance, they can really juice the economy and they can really juice inflation. So my expected path for the Fed is that they're going to continue to lower rates. They're going to try to target that 2.83%, but it's going to be really slow. And they're probably going to potentially pause. And we've been hearing a lot more about that recently. Based on some of what Trump may or may not do.
Do you see them reaching that lower rate by the end of the year of next year, or do you see it dragging out even longer?
So the Fed, 4 times a year, issues a summary of economic projections. The last one was in September. And in that one, surprisingly, they only had 2025. They had 4 rate cuts at 25 basis points. The market is currently pricing in somewhere between 2 and 3. So I think it's going to take them 2 years to get to that, 3% targeted Fed funds rate. I think they're going to go slow.
I can agree with you on that.
Yeah, I think we're all in agreement with it. I think the fact that the market initially thought that they priced in even more rate cuts, but I think they're going to drag it out a little longer than that.
A year ago, we were looking at a recession and whether we were going to have a soft landing. And now we've completely priced out the recession and it doesn't look like we're landing. So, a lot of that is what's driven the drop, then the rise in rates, as well as I think what's gone on in the stock market.
Jim?
I was just looking at your chart there again, Bill, for your outlook. I was trying to read it from this distance. Mm-hmm. But you were bringing up a subject in there regarding unemployment. What are your feelings with all that? And do you see the deportation of the immigrants an issue?
Well, I guess my thinking is, as we've just gotten through the political season and getting bombarded with texts and commercials and everything else, I've tried to look at reality instead of sound bites.
Okay.
And I don't know that they're gonna deport the people that have taken the jobs. I think that the deportation is gonna be around people who are criminals, who who we wouldn't want in the country.
I agree
Uh,
with you on that. I hope that's the
and
case.
and it's different than what the soundbite was coming from the Democrats, was that they're just going to kick everybody out. That's not going to happen.
Okay.
It's not feasible,
No,
especially if many of these people do want to assimilate into our country. Um, but putting that aside, I guess to take on the second piece of Jim's question, how does that affect the credit markets itself when it comes to you and investing? Because unemployment. We were having a discussion earlier. The unemployment numbers were was coming out of the labor and statistics. The Bureau of Labor and Statistics, a lot of that was revised downward much of this past year, and the Fed relies on those numbers, and a lot of other companies rely on these numbers too to make decisions. So I think this Friday we're supposed to get a new report on the employment numbers. So are we going to rely on that again, and then 2-3 months down the road they're going to revise it downward? Is that trend going to continue, or will that change in the new administration? Will they, look, I've never, going back to the '80s, you just learned that you take government statistics with a little bit of a grain of salt. You still have to make some kinds of decisions based on that data, but how reliant should we be, or how reliant perhaps are you when it comes to making decisions, both in your equity portfolio, but more, more of a focus here on the fixed income portfolios themselves and the credit markets?
to answer your question, yes, we will rely on them, and yes, I expect them to be changing or changed. Um, I think one of the best ways to look at unemployment data is to look at the 6 month rolling average. So it spreads out a little bit of the ebbs and flows. Um, I don't have the exact number, but if you look at the statistical margin of error, it's something like 100,000 jobs.
Okay.
So to get all buzzed up on CNBC or Bloomberg or whatever you watch because we're at 145 instead of 155 or vice versa, I don't get real buzzed up about all of that. I also look at some anecdotal stuff. I have a lot of small business clients. I have a son who works in the employment business, and I use some of those things also to kind of give me some color in and around the numbers. But we have to remember that we're still going through a lot of demographic things. A lot of people retired and took Social Security early during the pandemic, and those people are not coming back. James, your taxes and Social Security. If you earn too much money between 62 and 67, you have to start giving back benefits. So a lot of those people are not coming back.
Right.
The largest graduating high school class in U.S. history is now 32 years old. So, that big bubble of employed people is going through and they're moving up the experience curve in terms of their lifetime employment. So we do probably need immigration to fill some of the entry level jobs. I also think that it's industry specific. I don't know, James, if you've spoken to any of your CPA friends, but they can't fill entry level positions.
Oh yeah,
Uh,
that without question. I see it even with CPAs, they have trouble finding good help. And but that's also that's in for them individually with their practice, but they also see it with their small business owners and small businesses that they cater to. So yes, it is in fact true. And if they do find someone or enough people, they have a different work ethic, and
Yes.
that's always an issue too. So, but I don't disagree with you either that we do need to have an immigration to continue to fill those types of positions as you point out. But there's another piece that's overlooked. We were discussing it before. Um, for example, in China, they have a housing issue but reverse of what we have. They have a
Mhm.
glut of between 50 and 60 million that units that are unused. We probably need one and a half times that just to cover the housing industry that we have a shortage here. So who's building them is really the question. The question that I'm taking us to is who's building all that. So you will need that influx of immigration to fill those jobs. I think I had read not too long ago that there is concern in the construction industry that 3%, approximately 3% of workers, that they would lose if that full deportation went through. I agree with going back to that comment. I agree with you. I do not think that that's necessarily going to happen. I think they're going to target those that really do not deserve to be here and are causing havoc in and around our communities.
I also think that with a Republican-controlled uh, Senate and House, that we may see an immigration bill that would actually get passed and maybe give citizenship to some of those people. It would be nice to see.
Yeah, perhaps, yeah. Um, they've dilly dallied with it a long enough.
Yes.
Do you expect that there? I'm going to give worst case scenario. Is there a possibility that we would face some sort of a credit bubble that might happen over the next 12 to 18 months or more?
Well, let's talk about how we get a credit bubble.
Hmm.
One is you have an economic shock, like the pandemic. Um, is it possible we could have an economic shock? Um, it would be a black swan event.
Or do geopolitical issues that are
Yes.
going on
Yep.
around the world.
Yeah.
That
I mean,
they're
the
wild
one that,
cards, more or
that
less. We can't predict those.
right. But in the other way that you have a credit bubble is when the markets would stop funding and refinancing out any debt that's maturing. And I think I made the comment before that one of the issues in the high yield market was the maturity wall. And what we've actually seen is a lot of that has now been termed out. Um, Also remember that, and I'm not a big fan of quoting this number, but there's over $7 trillion in money market accounts. Now, I think most of that is staying in money market accounts. Some of it could migrate out to investment grade corporate or other higher yielding uh, fixed income products as the Fed cuts rates.
Now that's
Uh,
$7 trillion, Bill. That's not individual money markets that are held by individual investors. That's a combination of individual investors and businesses alike. Correct?
yes, it's everything.
Mhm.
Um, but I don't have my chart on that, but I know that, I've already talked about taking some of what's talked about on Bloomberg and CNBC with a grain of salt. But when they're talking about $7 trillion coming into the market, there was over $3 trillion in money markets for like 15 straight years going back before it just started rising. And if you look at the individual, the times that it went from 3 to 4 to 5 to 6 and now to 7, there were very specific events. And obviously the most recent was, about the people making sure they had coverage or having amounts above 250,000 in FDIC insured banks. So I think people woke up to that. They moved the money into money market accounts. There's been significant regulation changes in money market account, and they're required to have so much liquidity. So I believe, obviously they're not guaranteed, but they're very, very, very safe.
Okay. That's good. That's good that's good to know. That's good information. I have we have a couple more minutes, but I have a question for you about what your thoughts and opinions would be on the incoming Trump administration and their policies with regard. And I know this is, it's a all-encompassing question with regard to the policies on tariffs and deregulation, tax cuts, and also their anticipated deficit cuts or even removal of certain agencies or gutting of certain agencies. What impact is that going to have on investing going forward for the new year?
Well, clearly, if there's job layoffs, that could have an impact depending on how broad and widespread it is. I I believe that, the biggest issue that we face and the concern, and some of this came up during the political season, and obviously we saw what happened in England with the gilts and the Liz Truss moment. But I think that given the size of the deficit as well as the outstanding U.S. Treasury debt, he's going to have to be very careful to not spook the markets. Cutting spending through this Doge program is a good thing. You also saw how careful President Trump was on picking his Treasury Secretary. He picked the one that the markets wanted, and we did see a reaction in that. So I'm concerned because you never know with Trump. You never know when he's negotiating or not negotiating. I think he's always negotiating, probably. He negotiates with foreign countries, foreign leaders, with markets, with everybody. I hate to be married to because he's probably negotiating what's for dinner, but
McDonald's.
Yeah.
That's easy.
But I do think that a lot of what he's doing is a negotiating tactic and trial balloons, and he wants to see how far he can push people.
Yeah, he's trying to get reactions to then take the next step. He's usually 2 or 3 steps ahead, but in his thinking, at least in some ways, some ways.
Yes, absolutely. So I do think he's going to pay. In the first term, he paid attention to the markets. So there will be trial balloons coming out. I don't feel like it's as dire as it has been in the markets in terms of, I don't think that the tariffs, if a tariff causes incredible inflation, he just won an election because there was, he ran on Biden causing a lot of inflation. He's not going to cause a lot of inflation. The second thing is, I think that he's going to find a way to shrink government and have it cost less. And thirdly, I do think beyond the sacred cows of Social Security, Medicare, Medicaid, and all that, there are places to raise revenue. I was kicking around with a client the other day that with the incredible market run we've had, 401k retirement plans, if you including 401ks, IRAs, all that, they've probably never been bigger in this country. What if he put on sale, converting to a Roth?
Right. Good
Do you
point.
think he could generate $1 trillion? I do.
Yeah.
Yeah.
Yeah. I would
Easily.
agree
I
with
do.
you. Yes, for sure.
He already did that in the Tax Cut and Jobs Act during his first term. He cut taxes for multinational companies to move money back to the U.S. James, if you remember, the tax
move
rule on
jobs
that
too.
was
And
you
move
pay
jobs back
tax
here.
to the foreign entity, the foreign country, and then when you moved it back, you pay tax again. And he lowered that tax rate, and that was part of his pay for in the Jobs Act and Tax Cut Act in his first term.
Yeah, and he's looking to
And
extend that and expand it as well. So we'll see what that
yes.
means.
So remember that in the Senate, you cannot close debate unless you have 60 votes. So one of the ways that the opposition parties kept things from happening was they'd never let you close debate. So they created an administrative rule that you could get around that rule as long as your bill had, for whatever you spent, you paid for it. And that's how Biden got through all of his major bills. It's how Trump got through his first major bill. They're gonna have to do that again.
Right.
So there's gonna be pay-fors for every giveaway. So whether he stops taxing overtime or tips or all that, there's got to be a pay-for it somewhere.
Yeah, understood. All right, Bill, we want to thank you for your time. We're really very grateful and appreciate this. And maybe perhaps in the near future, we'll have another discussion, maybe sometime in the middle of the new year, and see what has transpired in the interim, and we'll review things again.
Sounds good. I've enjoyed it.
All right. Okay. Thanks. All right, Bill. Bye-bye now.
Take care.
Thank you for joining us on this episode of Enlightened Wealth Strategies. We hope you found today's discussion insightful and inspiring.
If you enjoyed this episode, don't forget to follow and subscribe to our podcast. You can find us on YouTube, Apple Podcast, Spotify, or your favorite podcast platform to stay updated on new episodes.
Your financial journey doesn't end here. Connect with us online for even more resources and exclusive content.
Until next time, remember, financial enlightenment is just an enlightened wealth strategy away. Investment advice is offered through Belpointe Asset Management, LLC, 500 Demont Ranch, Parkway Building 700, Unit 700, Reno, Nevada, 89521. Additional information about Belpointe Asset Management is available on the SEC's website at www.advisorinfo.sec.gov. It is important to read our disclosures available at this link, www.belpointeasset.com disclosures. The information provided in this presentation is educational and limited to the dissemination of general information. This material is not intended to be a recommendation of any kind, investment, tax, or accounting advice. Does not constitute a solicitation to buy, sell, or hold a security or an investment strategy, engage in any financial transaction, and is not provided in a fiduciary capacity. The information provided does not take into account the specific objectives or circumstances of any particular investor, or suggest any specific course of action. Investment decisions should be made based on an investor's objectives and circumstances and in consultation with his or her financial professionals. While the advisor uses reasonable efforts to obtain information from sources believed to be reliable, the advisor makes no representation that the information or opinions contained in this material are accurate, reliable, or complete. All information and opinions contained in this material are subject to change without notice. The views and opinions expressed are for informational and educational purposes only, as of the date of the production or writing, and may change without notice at any time, based on numerous factors, such as market or other conditions, legal and regulatory developments, additional risks and uncertainties, and may not come to pass. This material may contain forward-looking information that is not purely historical in nature. Securities offered through Fortune Financial Services, Inc., member FINRA and SIPC, Belpointe Asset Management, LLC, and Fortune Financial Services, Inc. are not affiliated. Past performance is no guarantee of future results. Investing involves risks. Principal losses possible.